monetary and credit policy. So first of all, we are covering monetary policy. What is monetary policy? Monetary policy is the combination of directions or policy directions issued by Reserve Bank of India to impact monetary variables in Indian economy. So whenever Reserve Bank of India issues directions with a view to impact the money supply in Indian economy, so those policy actions are called monetary policy. Monetary policy is an annual policy. It is formally announced in the beginning of the financial year, normally in the month of April. But Reserve Bank of India can change the policy from time to time according to changing situations. What is objective of monetary policy? Objective is to regulate money supply with a view to provide adequate liquidity to the economic system so that growth is not affected. Economy requires liquidity for the purpose of growth, and it is one of the objectives of money supply that adequate liquidity is available in the economic system so that growth is not hampered. Simultaneously, to create an environment of price stability. So another objective of money supply is to ensure price stability. What are the monetary policy tools? RBI makes use of different monetary tools to apply the monetary policy effectively. So these tools include: number one, statutory preemptions, namely cash reserve ratio, statutory reserve ratio. Second, open market operations, that is sale and purchase of government securities by RBI in the open market. Third, sterilization operations, to neutralize the impact of foreign exchange inflows, creating liquidity in the economy. Number 4, bank rate, repo rate, marginal standing facility, that is MSF rate. So according to its requirements, RBI makes use of these tools to impact the money supply and bring price stability. Credit policy. Credit policy is also administered by RBI. It is also announced simultaneously with monetary policy in the beginning of the financial year. But it can be changed by RBI anytime according to economic conditions. What are the objectives of credit policy? The first objective is to ensure that all productive sectors of the economy get required credit from the banking system. Those who want to produce goods and services, they should not feel handicap of availability of credit. So to make credit available to all productive sectors of the economy, so that is one of the objectives of credit policy. In addition to credit availability, the objective of credit policy is to ensure that credit cost is reasonable. Those who want to borrow, they should get the money at reasonable cost, at reasonable rate of interest. For this purpose, RBI gives different type of directions to banks. Let us see what type of directions are given by RBI. Number 1. Directions relating to interest rates on the loans and deposits. Number 2. Directions relating to focus areas for credit disbursement. Number 3. Selective credit control. Number 4. Fixing risk weightages for capital adequacy norms purpose, so that the banks are encouraged or discouraged to lend that particular sector. Directions relating to income recognition, asset classification and provisioning of non-performing advances. Different type of restrictions on lending to different sectors of the economy. Let us have a view of policy rates of Reserve Bank of India. The important policy rates include repo rate, reverse repo rate, marginal standing facility rate, bank rate, cash reserve ratio percentage, statutory liquidity ratio percentage. All these rates are changed from time to time depending upon the economic conditions. Thank you for watching this video. We hope that the contents have benefited you. Thank you once again.